extraordinary book, really about starting how to think differently about the world. How to not to follow what's cool or the social people, like really finding who you are and where you want to go, and really about non-conformity. So that's why I think my entrepreneur roots really began. Thank you, Mrs. Finnegan. And then in college was really a time of sex, drugs, rock and roll, and everything else under the sun. But that was really where I started to really think about life differently. So that was, again, starting to set this groundwork for not wanting to follow the status quo. I think life has this super strong inertia where everyone sort of follows into what I call the zombie path, which is you go to school, you get a regular job, maybe you get married, and then you flow into literally the same kind of structure, which I think has created some interesting challenges for us. Again, lots of climate change issues. I think the economic system that exists today has really just benefited the top 10%. So there's a lot of, I think, work and paradigms that have to really be reinvented. And we'll talk a little bit more about that today. And then my career track began on a technical track, and then I moved into product management. And what I learned there was sort of two things. Lots of Steve Jobs and others talk about follow your passion. And I think I'm going to twist that around just a little bit. I think you follow things that you're really good at. That's really what creates passion. So my advice is to experiment, try a lot of things. You're going to fail at a lot of things. And as you start to find what you're really good at, guess what? You're going to be really passionate about that. And for me, I found out that happened to understand technology well enough to bullshit my way through a bunch of stuff, but more importantly found that I really started to understand like this whole concept of a product and what a market might look like and the beginning stages of that. I went out, as I said, to create US Web. It was a unicorn startup, and I think what I learned there through that lesson was really what not to do. So what I found in working with entrepreneurs and myself being that is that, and Steve Jobs does this really well, he talks about it in his book, as does Elon Musk. I had the opportunity to work for Elon. And the hardest, trickiest part is really what not to do. Because I'm sure if I grabbed half this room and said, let's sit down, let's brainstorm, let's create a whiteboard, we could generate millions and millions of ideas. And what really finds out is that it's the clarity of your vision. You have a really clear vision of where you're going and how you're going to get there. And then, and I'll give you an example. In Steve Jobs' book, when he came back to Apple in 1997, there was 350 projects going on at that time. And he took his, a group of about 200 of his top people, they went to Hawaii, and he said, I'm going to lay out a vision of where Apple's going to go. And he said, as we are moving into the 21st century, we're going to be, humans are going to be living an entirely different lifestyle. We're going to be living in a digital era. And I want you to think about what that means. Living in what a digital era is going to look like. And he articulated a little bit about that. And then he said, what are we really good at? He said, we're amazing hardware engineers here. We're amazing software engineers. And we have incredible user experience talent. And we're able to bring that all into one incredible experience that no other company in the world can do, is to create these technology products for the new digital era. And then that became their blueprint. And everything was maniacally measured against that. And when they were done with the exercise, and this was a really hard thing to do, they went from 350 projects down to 10. And I see that all the time, even dealing with Elon Musk, being in a meeting. Hey, that's a really great idea, but that doesn't fit in with our vision. That's not the most important thing we should be doing right now. That's a great idea, but that's not the business that we're in. And constantly focusing the business on understanding that our vision is to accelerate the adoption of sustainable energy. It's funny, the companies that have been so successful, I remember the vision and mission from today. Back at Novell, I started Novell in 1991. Our mission was to grow the networking business. And I remember to today. And so clarity of vision and having a coherent strategy of how you're going to win at the end of the day. So what I learned at US Web, we had lots of opportunities, and you can basically completely bifurcate yourself and end up doing a lot of things really on average, with things that are really important really, really well. What you find out, like in life, everything is resource constrained. And the most important resource that you have is your time. You can never get your time back. If you dent your car, you can take it to the auto body shop. If you rip your shirt, you can sew or buy a new shirt. You can never get your time back. So really focusing that energy and recognizing that it's a constrained resource for you is really critically important. And that's a hard, even for me, when I started out as a product manager, I wanted every feature in that product. It should have this, it should have that. needs to do this, it needs to do this, and what you find out is that you end up with a product that's trying to be the Swiss Army knife, and it doesn't serve your target audience really well, and you get off track. And then you also lose valuable time in the market because you're creating all these features that your target customers don't really want or need, or aren't a hard priority for them, or the user experience isn't really elegant, right? So moving on, I created an incubator called Intend Change, had some success. We had more failures than success, and that was sort of the first time in my life that I went through that. And I learned a lot about humility and how important that is in life, is understanding that you know better than anyone else. And having that humility, what came at a really, really good time for me. It was a humbling experience, it was a character-building experience for me, and I felt like the universe was talking to me on some level about where you're going and how you're going to get there, the kind of person that you want to be. And that started to formulate a little bit about my longer-term vision and planning, which is that, and I think that we all have a deep moral sense of responsibility to ensure that future generations have at least a better opportunity than we did, or we do. I don't think we're fulfilling that obligation today. So I'll talk more about that in a little bit. And then I had the opportunity to join a nonprofit board, Dr. Richard Leakey, Wildlife Direct. Dr. Leakey is an incredibly amazing individual. He really opened up my eyes to climate change. He wrote a book in the early 90s called The SICC Extinction, and he's chronicled the exact path that we're on now. We're dealing with a massive existential threat around climate change, and unfortunately, it's talked to 99.9% of any scientists out there, it's man-made. It's the CO2 emissions that we're emitting into the atmosphere that are now, I think, at 420 parts per million. So he started to shape my views really around that in a very important way. And then a little bit of bragging. I had never golfed. I started golfing. Of course, I like to do things well. I really got good instructors. I got 3 hole-in-ones. Got to go surfing with Doug in Indonesia. So there's some really great waves. I'm still alive to talk about that. I wrestled in high school and college, and I decided cage fighting would be a cool thing to do in my mid-40s. I trained with a 4-time UFC world champion. Let's see, what other cool stuff have I done here? And I think the lesson out of there was live your life to the fullest. That should be your sole objective. And there's this famous Indian guru named Oso, and he wrote a book about fear. And it was an extraordinary book. There's a Netflix documentary about this individual. It's so cool, so crazy. But this existence that we have here in this human body has a beginning, a middle, and an end, right? So when you are at that end stage of your life, you don't want to be looking back, having regrets. I should have did that. I should have did this. And the more time you spend over your skis, and the more time you spend outside of your comfort zone, is the better and more enriching your life is going to be. Because life, at the end of the day, it's not about what you acquire. You don't take anything with you. The magic is the journey. That's the magic of life, is that journey. So you want to be out fulfilling that day in and day out. Now that's not to say that I don't have regrets. I do. There's stuff that I would do differently. It's easy to go back and look at that, but at the end of the day, I really don't. I'm blessed with what I have, and every day I strive to be pushing myself to the fullest extent. And then lastly, as Doug said, executive vision of Solar City, Tesla, and for the first time in my life, I was thinking about, well, how was I doing all these big corporate jobs? Being a type A person, I enjoy my role at Stanford. I don't have a PhD, and I don't have education background. So I felt my value proposition was to bring all this real-world operating experience into the classroom, these baller positions. And on top of that, I came to this epiphany, which was are you really happy doing that? And the answer to that was no. So there's constantly, am I creating a better version of myself? And reinventing yourself, because there's nothing you can't do in life. And I said that, why am I chasing this if I'm not really happy? This is an ego thing that's speaking for me and taking over. And for the first time in my life, I've always had my career and everything planned out. I'm going to do this, I'm going to do this, then I'm going to do this. And for the first time in my life, the chapter's unknown. And I'm embracing it, and I'm loving it. More doors are opening up for me. And that was sort of how this restless soul meets this entrepreneur. So the platform that I'm working on is really all about how do we inspire creativity for greater good. So I've got an ending video on that. That really wasn't my talk here, but I did want to go through the pop quiz. And as it dawned on me, We're gonna have to do this at the end because my laptop's not up here and I forgot I have to give you guys a code to do that. So pop quiz at the end. Sorry about that. Okay, so let me get into the startup financing blueprint. So this is what the world looks like for a lot of you out there today. So there's the point of what's called the valley of death. So you can see here, we've got that blue demarcation line. So everything before that is really all about you have an idea. You think there's an unmet need in the marketplace. You think there's potentially a big market for that. Maybe there's some customers for that. You think you might be able to actually make money at creating that business. So this period here is really all about the valley of death because things are in an infancy. It's really, unless you're Mark Zuckerberg or some other super successful entrepreneur that can raise money with the drop of a hat, everyone starts out in this area here. You're scratching, you're clawing, friends and family, you're emptying your own 401k plan, maybe maxing out your credit cards, putting everything that you have into the cycle here of the valley of death until you can actually get a product together, maybe an MVP, a minimum viable product. Does it identify who the target market is? Is that market big? Is it growing? What's your competitive differentiation in that marketplace? What's your business model? How are you going to make money at the end of the day? So this is where a lot of companies spend their time. Unfortunately, not many make it out of the valley of death. And that's part of what I'm going to talk about today, which is this chasm between, I have this killer idea, I can't believe investors aren't lining up and taking wheelbarrows of cash and dumping it into my bank account. And we'll talk about that side. But if you are able to cross that, then you typically get into maybe a formal seed or angel round, maybe some institutional money, and you go through the traditional path of number first and second and third, maybe the mezzanine round, and then typically what are investors looking for? A return on their investment. Hopefully you are too. You probably have a lot of sweat equity in the business that you built from scratch, and are looking at some point in time for a liquidity event, whether you end up selling your company or you have the opportunity to take that public. But that's sort of what that blueprint looks like for that. So let me share with you some really important investment data. I have the opportunity to have access to a platform called PitchBook through my position at Stanford, and most of this data has come out of there. This is the most recent data that they published. So the good news is that VC investment retains a ton of its momentum from 2018. So the way venture capital investment has looked over the last 25 years, we had this thing called the .com, and the internet got invented in the year 2000. Was a massive spike with venture capital. It topped out at about $10 million. And then we had the .com bust, and then the market sort of fell out, the bottom fell out, started to do some rebuilding. Web 2.0, social media got invented, there were really great innovations. And then had another bottom drop out, the housing crisis, which started in 2008. And then since that time, we've worked our way through that, and we've seen a very healthy cycle of investment capital. Now, I have a personal point of view on this. I think that the key for any business to be successful in the 21st century is all about innovation. You're not going to succeed. The world is moving too quickly. Paradigms are being reinvented so fast. Go-to-market strategies are being reinvented. And if you're not focusing on innovation, you're going to get left behind. The world's getting smaller and smaller, and the cycles are moving much, much faster and faster. The only way to combat that, in my point of view, is through innovation. So I think that we're going to see at least 1 to 2 decades of additional healthy investment in venture capital, despite some of the macroeconomic headwinds. And it'll be interesting to see how all this plays out, but despite all of the fluctuations that are going to occur in the big macro capital markets, I believe that venture capital investment is going to go through at least 10 to 20 years of additional strong investment. And my take on that is that we're probably going to come close to $200 billion invested this year, $130 billion last year. So we set a record last year. I believe we're on pace to at least match or beat that this year. And I think that cycle is going to continue. I think we're going to see a day, all of us are going to see a day when $1 trillion is invested in the venture capital space. That's the good news. Now, the bad news is it's really, really hard getting access to that capital. So the stats go like this. So if you take the universe of early stage startups, only about 10% of those have the opportunity to actually get in front of institutional money. So on average, if you've got 700,000 startups, only 10% of that gets a meeting with some institutional money. And then of that, only 10% of that actually someone who will write a check. So lots of great startups, big money over here, it's really hard to get access to that. So I do think, and I'll talk about how to, I think, change that dynamic and change a little bit of that math. But just overall, the macroeconomic picture, I think, looks fantastic. As a matter of fact, to add a little bit more color into this topic, there's certainly some dire predictions about artificial intelligence and robotics. Shark Tank, Mark Cuban, I think, predicts that by 2030, we could have 30% unemployment because of AI and robotics. That's somewhat staggering. I look at the other side of the coin, which is that what will never be replicated, ever, by any technology, I don't believe, is the infinite ability of our species to be able to create. And that's where the talent and the magic lies. That's how you can create value for the company you're working with today or the company you want to create tomorrow. It's all about this infinite ability that we have to create. That's where the magic is. So, yeah, it'd be great if you could code. I would say, there's going to be a lot of jobs in coding. If you know how to sell, the company's still going to have to learn how to sell. But bring this entrepreneurial spirit, this creative spirit to everything that you do. You're always going to be in demand. Constantly in demand. Liberal arts degrees, awesome. Literally, any major that you love and want to do is because creativity doesn't look at a major. Creativity doesn't look at a person. And that's what makes our species so unique, is this infinite ability to create. You just have to know how to use it. You all have the power. Everyone has the power to tap into that. So, I believe that large corporations, they're going to basically, what are they going to do? They need innovation. They're going to continue to buy companies. Cisco continues to buy companies. Salesforce continues to buy companies. They're buying innovation and they're buying talent. That cycle is going to continue. So whether you have the great exit through an M&A program or you get to the promised land of an IPO, I believe that strategically we're going to continue to see, because I think the returns are going to be so strong, and the need at the corporate level for M&A and acquisition of innovation is going to be critical going forward. So good news is the macro story looks fantastic. Okay, projected global venture dollar volume through Q2 also looks healthy. Now, a little bit down to flat, but overall you can see here the seed, and this is dollar volume. So clearly, ton of money going into late stage, these type of mezzanine rounds, but I'm actually going to show you that angel and seed round is still quite healthy. Huge opportunities in that space. But by and large, we saw Uber raise tons of money, WeWork trying to get public raising tons of money, but the distribution here is we had a really massive Q4. The good news is we had a very strong Q1 and a super strong Q2, and I think the prospects are that we actually will have more venture capital money invested this year than we did last year. So I believe that we're on pace to match. I think we're going to beat that. So projected global venture deal volume. So this is now, last chart I showed you was dollars. This is actually the number of companies. So as you can see, the angel and seed round in the blue at the bottom has been very strong and very healthy. You can see an uptick there in Q1 and in Q2. So there's some challenges. I've got more data to illustrate on that, but you can see that there's still plenty of opportunities for early stage companies to access necessary working capital to really grow their businesses and create value. So this is a very strong, healthy chart. Now, projected Q2 2019 seed and angel, and this is globally. So it's a little bit flatness here in the US, but overall from a global macro picture, still very, very strong and very, very healthy. So you can see in the blue is the capital invested in seed and angel rounds, which are typically about $2 million or less. And then the white line chart is the actual number of deals. So we topped out at almost 5,500 seed and early stage deals that were just funded alone in Q2 of this year. Globally, almost $4 billion. So, very healthy macro view of the entire venture capital space, and really great opportunities in the seed and angel space as well. And then you can see here, this chart shows the average round in Q2 in 2019. So the blue is the average, and then the white is the median. So as you can see, average at 1.6. So we've seen almost 60, 70% increase just from Q2 of 2018. So very healthy growth in seed and angel space as both new types of investors entering the market. A lot of the venture capital have also been buoyed by large corporations because not only are they acquiring these early stage companies, they're also investing in them. Typically, private equity firms were mainly late stage. They find a distressed asset, see a lot of debt on that, they come in and buy it at a huge discount, they restructure the debt, package it up, 3 to 5 years later, unload that thing for a huge profit. So they're also now down in this venture capital space. So they're in early stage, Series A, Series B. Some of them actually have funds that are focused on seed and angel rounds. Google, Salesforce, so lots more money. And then you've got folks, individual investors, people like myself that don't have huge money, but interested in working with the right types of startups. So there's a massive syndicate of angel investors and folks that are looking to put some money to work, looking for a great return. And then free money valuations also have continued to be very healthy and on the rise. So you can see the top echelon of companies on the green line, the median, and then the 25th percentile. But again, just look at the trends from where we were in 2009 to where we are today. So what that's showing is that it's basic economics, right? Who took an economics course in college? Supply and demand. So what's happening is there's a lot of venture capital money coming into the system, and if demand stays low, then that pushes prices up. That pushes those valuations up. That's what we've been seeing over the last several years in this space. And then the acquisition of venture-backed company globally. So at the end of the day, investors want to make a good return on their money. It's a big risk. They want to really a commensurate return with that risk. And as I said, they typically usually get it through 2 avenues. The company gets acquired at a good valuation, or gets to cash out, or the company gets to go public, and the equity that you had at your startup now is publicly traded. You can go and trade that on NASDAQ or the New York Stock Exchange and get liquidity that way. It's fairly rare, but there are companies that follow a path of dividend. There's some specialty companies that do that, but largely what investors are looking for is, I made a big risk, the company did really well, thank you so much, and now I have the opportunity where I get cash back with hopefully a big return on that money. So this is showing that we're still seeing very healthy acquisition of firms. The total dollar amount, $52 billion just in Q2 alone, and 357 companies that went through and experienced that. Now, the median and average VC fund size. So this is what I was talking about. Here's the fuel source. What do these venture capital funds look like? So most of the funds are raising larger and larger funds, like the biggies, Andreessen Horowitz, NEA, Excel, Benchmark, Sequoia, and lots of new funds that are also entering into this space that are looking to basically deploy capital in this area. So we're seeing that fund size, the total dollar amount continues to go up because there's an exit path there. And on top of that, we are seeing that the fund sizes are also getting larger as well. Some of the larger ones have separate teams that focus on angel and seed, some early stage and late stage, and some of the more boutique firms are strictly focused on just a specific area. So for example, Streamline Ventures, a good friend of mine, he just got ranked as one of the top 50 angel investors in the world. He just raises about $25 million of funds and deploys that just in angel and seed round, and I'll talk about sort of his views going as well. So very healthy landscape there. And then IPO portion of exit values goes to a record high. Now, I do think that this is a little bit inflated. I think that the macroeconomic issues will start to temper some of these exits. We have seen, Uber coming out, Lyft coming out, WeWork trying to get out, Peloton just got out, a number of very large, high-profile companies. So you can see in the chart here is the greenish color is liquidity through acquisition. I think your company was bought, and then an IPO, and then typically a corporate buyout on the blue there. So that IPO band, I think, is an anomaly. I think it's extraordinarily high, but nonetheless, we're seeing a really great cycle. So the way venture capital firms work is they set up a firm, and then they go out and they bring in what are called limited partners, wealthy people that invest their money in that. So you can see the turnover there is you invest in a venture capital firm as a limited partner, you get a really great return, and then you put that back into the system, and you see a really good, healthy ecosystem. So despite, I do think we've seen kind of we are going to see some valuation adjustments on IPO, the story is still very strong and very positive going forward. And to illustrate that point, What we also have as well is that $100 million plus exits also take further market share. So this was the valuation at the time of an exit. So you can see it over $500 million in aggregate. That top bar, part of the stacked bar, the strongest it's ever been. The 100 to 200 million, also very strong. So you can see there's just also been this valuation that's been created through both M&A activity and IPO activity. Again, all signs of a very healthy climate, venture capital investing, healthy opportunity for new startups that have exciting ideas that want to change the world. So, angel and seed investment, this is where a little bit of warning sign. I wouldn't say it's anything panic, but the message I think is that the dynamic I do think is going to change a little bit. So I think the bottom line is that entrepreneurs are going to have to show more traction, probably get yourself to a minimum viable product in order to maintain, to raise necessary venture capital to grow your business. So again, you can see here the angel and seed round. The aggregate might look like it's coming down, but it's still very healthy. The blue is the deal value in billions, and the yellow line is the deal count. And I highlighted the research note here, and I underlined, I think, the most important part, the takeaway from this slide, which is that startups should at least have a minimum viable product. So when you have a situation where there's more venture capital than deals, that means that the traction that you need, the bar is lower. And as this starts to tighten a little bit at this round, that means that kind of more constrained capital. You have the inverse from the economic standpoint, which is that more startups and less venture capital money. What does that mean? That means either both valuations and where you need to be as an entrepreneur, what you need to deliver, the kind of traction that you need, is going to have to be higher than it normally has been. And I think the standard barrier for that is if you're not at a point of a minimum viable product generating some revenue, it's going to be a lot harder to raise venture capital money going forward. And lastly, how many females do we have out there? Awesome. So one of the things I'm focused on is driving more diversity, and certainly love to see female founders. Two-thirds of the boards I sit on have a female founder. And the pace that we've seen 2019 on pace for a record year of VCs who have invested into female-founded businesses. A really, really great sign. Just not a male-dominated business anymore, both from the standpoint of female founders, diversity, folks of color entering into the space. All the signs are pointing in the right direction. So, overall, hopefully that gave you some good data. My takeaway, I'm always, the glass is half full. I feel I'm always grounded in reality, but folks can read what they want out of it. For me, attitude is everything in life, and I've been through lots of different cycles, despite some of the macro fluctuations that I think we're going to experience. I think this is one of the best times that you could decide to be an entrepreneur. It's tough to talk about the pitfalls of that, but there's never been a better time than now is to accelerate your business. If you have an idea, start working on it to see if there's a market for that idea. I personally think that we need more entrepreneurs. That's the way to change the world. So, let's talk about why startups fail. The number one reason why startups fail is, unfortunately, there's no market need. So this idea that you thought was so awesome, I've been there, I've had more failures than successes, and this idea is so great, and it's going to solve this problem. Customers are going to be lining up to buy this thing from us. What ends up turning out is that 40% of the reason why startups fail, unfortunately, is because when you get that product to market, either the product doesn't function like you thought it would, doesn't have the feature set you thought it would, the target audience that you thought it would fit, doesn't really fit that. And largely what it turns out to be is that I see too much of this, which it's nice to have. And if you think about it, if you've ever been in business, cash is king. So even a large business, they're going to focus on, hey, can this accelerate my revenue? Because that's going to create value for my company. Can this substantially help me cut costs or be more profitable? That's going to be super something I'm interested in investing in. So a lot of times what we end up seeing is that it's not that, and try not to take that the fact that your idea might not be a hit personally. Like, you're always going to have more failures than success. As a matter of fact, the story that I think best illustrates this is there's a Netflix documentary about the Eagles. Love the Eagles. I'm really dating myself now. This is my gray hair. But so they were doing a documentary, and then Glenn Fry had started the Eagles with Don Henley, and moved to Los Angeles, and they were living they were in an apartment, below them was Jackson Brown. And Glenn Fry talks about every morning he'd hear Jackson Brown's teapot going off and whistling away. Then he'd go over to his piano and start playing a song over, over, and over, and over, and over, nonstop. And he said to himself, like, not this, and I was like, oh my God, that's how you create a song. It's elbow grease. It's working hard. It's failing and getting better and better. And that's exactly what you're going to have. This failure rate is so high. If you're not failing, you're not pushing yourself. So despite your idea might not work, or investors may only invest in that, don't take that personally, because that's just the nature of the beast. In this case here, you want to find out sooner rather than later that you're off track, or it's not going to work. So you're not wasting your time or your family's money or your own money in there. But a lot of times, that's the most important issue, is that, is this really solving a problem? A real problem, right? And we'll talk more about that. But that's the number one reason why startups fail. No market need. Number two, and I see this all the time, is they run out of cash. So being able to manage cash is really, really critically important. And sometimes just working with a venture capital fund, they ended up, they're between funds, and they might still love your company and your idea, but you've run out of cash. You have no options at that point in time. So managing cash is critical. It doesn't mean that you don't spend money. It means you're very careful and focused, and you're investing in things that are going to move the needle. What you have to be thinking about as a founder is that I have limited runway. So whatever that money is, let's say my burn rate's $100,000 a month, and I have $1.2 million of cash on my balance sheet. I have 12 months of burn. Now, hey, I want to hire a couple other engineers. Okay, that's cool. That's going to increase your burn. That's going to shorten your runway. I haven't thought about that. I want to spend more money on marketing. Okay, great. I want to get more revenue. But if that revenue doesn't come in, and what you need to be thinking about is that in most cases, what did I say at the beginning of my talk as an entrepreneur? You're always raising money. So what you have to be thinking about is that, when's the next time, the right time I can raise some money? And then more importantly, where does my business need to be? How much should be generating revenue? What should my gross margins look like? Or my ARR? And thinking through, having a strategic plan, like, my business needs to be here, my runway's here, so am I going to invest the money that's actually going to get me to those milestones and tractions that I need to qualify me, put me in the best position to get that next round of funding done? And you have to be really maniacal and focused and manage that, because once you run out of money, I don't care how good your idea is, what your patents look like, how much revenue you have, it's effing game over. There's no tomorrow. That's the abyss. Because people need to work. They need to pay their bills. So your engineers are going to stop working. Like, the whole thing just comes to a screeching halt. So understanding how to manage cash is vitally important, and that needs to be built into the DNA of the company. And one of the things that I learned at Tesla was that, Elon literally scrutinized almost every expense in that company. And it was just more about, he wanted to set the right culture, so people weren't wasting money, buying private jets, doing stupid things that are pissing through really valuable cash that aren't really focused on creating value. So managing that cash is going to be critical. That's the second reason why startups fail. Third, unfortunately, is the wrong team. So you got to get the right people on the bus. You got to get the people in the right seat. And that's lots of times very difficult, very challenging, because you're constrained. I can't really get this person that I want. They want too much money. But by and large, this is, one of my startups failed exactly because of this. I should have taken my own course at Stanford. I had the wrong CTO in there. It's more my fault than his. I should have known that going in. And then lastly, you can actually get all of these right. And I've seen companies that just can't execute to save their life. Either they're too defocused, they're chasing their tail, they don't really know what they want to be, they're completely off base, they're not validating their idea or validating their product, and their execution is terrible. So those are the top 4 reasons, a bunch of them, but that's it. Product market fit, I run out of cash, I get the wrong people involved, and I can't execute at all. So,
other than that, we're good.
From the venture capital side, so if you've ever had a startup or worked with one where you've got a venture capital sitting on your board, is that Chrissy over there? Chrissy sit on some boards. This probably rings true to you. Chrissy Meyer from Root Venture. So why VCs look at why startups fail is 95% they fall short of meeting their projections. So how many put out revenue plans knowing you're never going to hit that number when you show it to an investor anyway? You're already starting to set the wrong expectation, because lots of times your cash your cash plan is built on that. So if you say I'm going to do $3 million next year of revenue, and you really only know you're going to do $1.5 million, but you set all your expense structure set up that way, your venture capital sitting on your board, and then you don't execute. So then you start to really fray that relationship, which is really critical for you going forward to keep your venture capital stay with you, seeing progress being made so they can continue to invest in your company. 80%, then once you start to get off track, say there's no return here, and they unplug at that point in time. 40% say that basically complete liquidation, I'm not going to get anything back out of this thing. And lastly, I think most important, it's a really good sign, because I don't believe in over-planning, I think there's too much analysis paralysis. What I'll call focused planning is really important. And having a plan. Does it have to be a 50-page business plan? But I've got a plan that I can share with my company, I can share with my executive staff, I can share with my board, and I'm focused on really having that, and most entrepreneurs don't have that. Okay, so crossing this chasm that I talked about, the investor chasm of entrepreneurs. So, what does an entrepreneur want? So on the X and Y axis here, on the X axis is value creation, and the way most of us think as entrepreneurs is that in order for me to create value, I need working capital. That's how entrepreneurs think about the world, and unfortunately, it is too blunt. You have too many, your blinders on. That's not the right model. This is what most entrepreneurs look at, and unfortunately, like this is the wrong way to be looking at a problem. And what does a venture capitalist or a seed investor look at? They look at it in opposite direction. They see along the y-axis risk, and then on the bottom axis they see value creation. So what they're looking to do is how do I mitigate that? How do I get from high risk, so how do I lower that risk and take advantage of the value creation there? So I'm going to talk about that dynamic going forward. So I have the opportunity to have a lot of relationships with really fantastic world-class venture capitalists. Three that I recently surveyed to get my own sort of temperature check was Graycroft. They have an office in LA, they're also in New York. Very successful venture capital firm. DFJ, which was the old Draper Fisher Fund. Heidi Rosenmayer is a longtime friend of mine. And I mentioned Ulas Nayak, who works at Streamline, one of the top 50 seeded investor angels rated in the world. And I said, tell me about what really drives an investment decision. So almost unanimously, it's market. How big is the market going to be? You may have a great idea, but if the market's really small, they're looking at big risk, low return. So the first thing that they're thinking about is like, is this big market opportunity that you think that you have this ability to tap into? That your idea is so unique, you solved a real problem, and the market opportunity is going to be quite extraordinary. So that's the first thing they look at. So they have a checklist. I guarantee you, Chrissy has a checklist here. Sit down. First thing she's looking at is like, hey, how big can this market really get? So, as I said, your idea might be great, but if it's a very small market, love the idea, super cool. It's just not the right. It's going to be really hard at attracting institutional money. The second thing we talk about, so the second reason why startups fail, is that they're going to look at your management team. And I would say this is just as important as the market. You can't. If you miss on any of these two, you're gonna have a really hard time attracting any kind of institutional money, or I think any kind of angel or seed money. They're gonna look at the track record. Is there synergy with the team? Does your marketing person actually have experience in creating awareness and interest in the trial and purchase in your market? Does your engineering CTO have a track record for building great products that customers love? All these things are gonna be critically important. And these are really hard challenges for entrepreneurs, because it's hard to pull a great talent out from a high-paying job that you're going to pay come for equity or $50,000 a year. It's just part of the landscape, part of the fabric of being an entrepreneur. But focusing on constantly getting the right management team in there is going to be critical to your success. Let me go backwards here. Number three is they're going to look for momentum. So is this thing at a complete standstill? Or are they starting to see like, wow, they've identified a really interesting market, their value proposition is unique, and I'm seeing momentum. Because what they're going to want to see is growth. So in addition, high market, really great management team, and this thing can move really, really fast. Remember what I said at the start of my talk? The world's moving so quickly. If you're not, and as part of one of your advantages of being a startup or an entrepreneur is the fact that you can move faster than a large business. So if they're not seeing that momentum manifest itself largely in customer acquisition or trials, or some way to substantiate that there's a real market here, customers are actually going to buy that, that's the third check mark. And then fourth is this thing called macro trend. So we're looking at, is this idea Does this play into our investment thesis as macro trend work? So a good example of that is a company like Uber. So when they got started, like, is this a macro trend? Like, taxis kind of suck. People don't like getting into them. They're expensive. They're dirty. Half the time they don't show up. This seems like a really interesting sharing economy idea. So it checks that box where we see that this macro trend could work really well. And to that extent, all companies are going to eventually go through some type of pivot. And talking about that macro trend, I'll give you one example of that. So anyone here of Slack? So Slack was founded by Stuart Butterfield. Stuart actually, in the early 2000s, created one of the first photo file sharing companies. It got bought by Yahoo for a little bit of money. He's always been loving games, massive multiplayer online game. He goes out and raises $17 or $18 million, and then they build this game, and it's a dollar. So he maybe has $2 million left on his balance sheet, goes to his board. Hey, do you want me to just return pennies on the dollar? Our product's not going to work. However, our internal engineering team built this little messaging thing called Slack. So our developers, they're remote. They can work better together, more productive on that. What do you guys think of that? They loved it, right? So what they saw here was a massive macro trend that, email is fairly antiquated, but this messaging thing could be really large. That fits in this thesis of macro trend, really big growth. So that's a good example of that. And then lastly, at the end of the day, no matter what, you have to make money, right? Although big Tesla can say, oh, they're never going to make money. I actually think they will. It took Amazon 25 years before they made a profit. I think Salesforce was over 20 years before they made a profit. But investors were willing, they saw the model. Eventually we see how this thing is going to turn into generating lots of cash, because at the end of the day, there's only one metric that's going to value your business. It's this ratio called DCF, discounted cash flow. So what they're going to do is they're going to say, okay, what could this thing be in 5 or 10 years? A discounted cash flow model, they're going to apply a multiple of that, like, wow, this thing super differentiated, potentially very high multiple on that, but that's at the end of the day. So you have to have a business model that can actually make money, so investors can see that they're going to have an exit at some point in time. Now, on top of that, that was great profit. They call it the 5 M's. And I think this is pretty standard across most venture capital firms. Draper Fisher, for them, was a little bit different. They wanted to kill their team. They said, we'd rather have a B idea and an A team. I'm not sure I agree with that, but I kind of get it. They kind of go hand in hand. And then, obviously, big market opportunity, because they're looking for a big exit. So the idea's got to be big, the market's got to be big, the team's got to be killer. And then the other question that Heidi said I thought was interesting, which was, you need to be able to sit down in front of an investor and answer why now. Why is your technology or your product why now? You articulate that in a way that resonates with your thoughts on understanding the market, understanding your customers, what their needs are, how your product fits into that. That's critical. And then lastly, last night was Streamline. So he described angel investing as like making sausage. He said, it is just absolute chaos because you're early, you're trying to figure stuff out. He's a roll-up-your-sleeves guy. He actually gets in there. He works very closely with the seed investments in that area. But for him, it's all same market thesis. Like, is this thing playing into a macro trend? And number two, like, is this team baller enough to figure this shit out? So overall, those are some really important themes that I think you need to be thinking about as you build your company. Now, let's talk about this chasm. So here's my sort of entrepreneur advice and then my investor advice. I'm going to wear 2 different hats right now. So on the entrepreneur side, I will tell you that you need to think big, really effing big. You have the ability. Most everyone just has this tendency to fall into the status quo trap and small ball thinking. So that goes back to my example of Glenn Fry at the Eagles in that it's like, okay, how do you iterate? How do you think bigger? And the more that you do that, the better odds that you're going to get your company off the ground. Because investors love to invest in big thinking, big ideas, change the world. They really thought this through. As I said, this is sort of the number one reason why businesses fail, lack of product market fit. So make sure you're solving a real problem versus a nice to have. Nice to haves are great. Companies don't have a lot of budget for nice to have. They have a big budget, like, oh, you can help generate more revenue for me? Great, super interested in talking to you. You have a way to automate my performance marketing program, even better conversion rates? Let's sit down and have a conversation, right? And then third, and perhaps most importantly, passion and authenticity are everything. Everything. And an investor you're talking to is going to read this the second you sit down with them. The reason why passion is so important is like, if this isn't the most important thing in your life, what's going to happen is that you're going to have massive ups and downs. You're going to have days when you have no idea how you're going to make payroll. You're going to have days where you're scratching your head going, why did I do this? And if you're not passionate about it, you're going to quit. And if you're passionate about the problem that you're trying to solve, or the business that you're trying to create, 90% of it, 99% of it is resolved in sweat. Sweat, blood, tears. So if you're not passionate about it, that's a massive red flag for an investor. And I think obviously authenticity goes without saying. Being an authentic person, being who you are. Your strengths are your weaknesses, this is who I am. Then we talked about getting the right people on the bus in the right seat. And I would say that a plug for diversity. Diversity is all about unlocks so much creativity for you. And I give you another good example. When Steve Jobs started Apple with Mr. Wozniak back in the 70s, most companies building microcomputers just hired engineers that could code in assembly language. Steve had a bigger vision. He went out and hired artists, he hired musicians, he hired calligraphers, and he brought in the most diverse talent, creative talent, to think differently, challenge the status quo. Another concept I like to talk about is this concept of it's still the art of the impossible, because it's going to be impossible when you're in there. So if you're a leader out there, or a CEO, or an executive in your company, that's the culture that you have to create. And seeing that really come to life at Tesla, where the demands are so huge, but there's an art of the impossible that exists in those companies. You've got to have that dynamic. Extraordinary leadership and culture is everything. Why? Because if your culture and your leadership is bad, number one, you're going to lose your best people. And number two, you're not going to be able to recruit really great people. At the end of the day, it's people or nothing. Let's see, relentless pursuit of customer delight. I talk about this all the time. When I worked at Tesla, there wasn't a day that went by that I didn't get some form of communication from Elon about a customer issue. A snapshot of a tweet, a forwarded voicemail, a forwarded email, fixes, why is this right? And what does that do? That builds a great culture, because everyone knows if you have a CEO that doesn't really care about the customer, then you're not going to really care about the customer. Right? So it builds the right culture, the right behavior in the organization. I talked about this when I gave the Steve Jobs apple about the number of projects that they went down to. It's focus, focus, focus. You have limited bandwidth, you have limited resources, you have limited time. If you're approaching it with a shotgun, you're going to be in deep trouble. If you approach this with a laser, focus your energy, communicate to your team. So everyone knows the vision, what your business strategy is, what are the key metrics, traction that you're trying to drive. Focus, focus, focus. Never lose sight of that. Because once you start to open up that Pandora's box, train gets off the track really, really quickly. Another startup in Santa Cruz that I've been involved in, I talked to the CEO, not sure they're going to make it, and said, hey, what was your big learning lesson through this experience? He said, speed. We did not move fast enough. And the window of opportunity, if you're an entrepreneur, is really narrow. So you could have the best idea, best funding, the best team. If your execution is slow, then you miss that opportunity. I've seen it way too many times. You've got to, unfortunately, this is a calculus that you've got to be thinking about. Speed's critical. Given the data that I showed you, I would say to focus on traction. Demonstrable traction that shows you've identified a market, there's a real need, your product fits that need, and your customers want to buy it. And you have competitive differentiation. And you have a real go-to-market strategy. Critical. So focus on your traction, focus on your customers, focus on getting revenue, proof points to show that you can actually proof points show there's a real market here, there's real customers here, and I have a business model that will pay for that. Cash management is critical. Anyone here heard of a book called Lean Startup Principles? Okay, if you haven't read that, you should. I think when Steve Blank teaches that at Stanford, probably one of the best books any entrepreneur can read. It's all about focus, managing your cash, a lot of things that we're talking about. And let's see here. We've got and then what I would call is the right mentorship, and networking is going to be critical. So unfortunately, as an entrepreneur, you are always selling because you're always having to be raising money. You got to continuously build out your network. You're running a lot of stuff down in here, and it's critical that you get the right mentors. That may not be your investor. Your investor may not know about your market or your product like you do, right? So getting the right mentorship is going to be critical. Now, the investor side, what I look at is a lot of what we talked about, right? Like, that's the first thing I sit down. I'm looking at an opportunity. What's the market opportunity look like? That one company that, I love them, that's the CEO has been given nothing but a bazillion% in there. But for market, when I sat down and said, okay, are you going to solve this problem or this? They said they were going to solve the problem that I thought was a bigger market opportunity, and they ended up focusing on the other thing that I would have not invested in had I known what I know today. So market opportunity is critical. Also looking at the team. You know, it's not going to be perfect to start. Like I said, early stage stuff is sausage making. Is there enough DNA in there? And is that team flexible enough to really get the right data and execute really, really well? So seeing that dynamic is going to be really important. There's synergy in there. That has a lot to do with it as well, right? I don't know if anyone here, the Jonas Brothers. Well, when they first started, they had big magic, 3 brothers together. Then they went off on their own. Now they're back together in the chemistry. You don't have to be the best talent. And I'm not a Patriots fan, but man, that organization plays like a team. Everyone knows their role. They don't have the best person in every position, maybe Tom Brady, but largely it's people like, you fit this role, you do this really well. I'm looking for product traction. I want to see some early product traction that you actually have something here that customers value. And that can come in a lot of different ways. It could come in pilot projects. It could come with some focus group work that you've done. There's lots of things you can do to solve that problem, like I need cash, I need cash, I need cash. I want to see that you've got someone in there that can manage the cash. I want to see that you have this ability to move very quickly. Fluidness and speed is going to be really critical. I want to see you really slot out an initial business model. Like, how are you going to make money at the end of the day? Have you actually thought that through? And is there some basic integrity around that business model that you've created? Also, I want to see that, is there competitive advantage? Why are you going to win at the end of the day? And a good example, when I went to Solar City, the reason I went there, I thought that their competitive advantage in the early days was that we were the only integrated solar company out there. So there's companies like Sunrun that just really did the financing to start. There's marketing companies, we did it all. And getting a solar product into that solar system is pretty complex. A lot of moving parts. Getting that customer experience right is critical, and I felt like Apple, the integrated model, was the right way to go. Over time, it became a commodity. Everyone's vertically integrated today. That's why it's really hard to make money in the solar industry unless you are at a really big, high-scale area. So for the early days, I want to see competitive advantage. Why are you going to win at the end of the day? Another area that is really critical that a lot of early-stage entrepreneurs miss is that, oh, I got a great product, I got a really great team, my business model is awesome, I understand my market, my segmentation, how I'm going to reach them, all of this. But last, at the end of the day, like, okay, what is your real go-to-market strategy? What's the engine between your product and generating revenue? And I see that gets missed so many times. And I'll give you a good example. When I was at my last stint, this company called PlanGrid. It was headed up by Tracy Young, phenomenal CEO. She was in construction industry. She was doing quality control. She was working on a Kaiser Permanente building. She had this pull cart of 3,000 drawings that she would wheel through floors and mark like, oh, this electrical outlet needs to be fixed. This door header's wrong. And she's like, this is crazy. We're in the digital era, and I have this cart of 3,000 drawings. The iPad got invented. She's like, that's the innovation where I can solve this problem. So she built a mobile-first tool that allowed now for virtually every construction worker to get rid of the pull cart and the paper and do it all on a mobile computing device. And so that was it was a great value proposition, but that's only half why they succeeded. One, the product was super easy to use. She said in her head like construction workers, most of them probably still have AOL email addresses. So this thing that it was super easy for them to use. So they nailed that. And that still wasn't enough. What they figured out how to do was that mostly when you're selling software to someone that's an EVP, a C in front of their title, or someone that's in the corporate office. That's how construction software is bought. They would have failed if they did that. Their sales strategy was they actually hired an outside sales team that actually got on job sites. They met with superintendents, they met with electricians, they met with plumbers, mechanical people, said, here's our great product, try it. And they unlocked the ability to purchase in the field, which had never been done before. That was a huge breakthrough. She went on to create a company that did $100 million at ARR. It was recently bought by Autodesk for $900 million. But that's what they had to do. They had a go-to-market strategy, was well thought out, and they did something quite unique that gave huge competitive differentiation. And the product was beloved. So what happened is that as more and more users got on, those bills got up to the COO, and they were going apeshit, like, oh my God, why are we spending all this money on PlanGrid? And they couldn't rip it out because their users loved it. The product was revered. And then last couple things, racing the product market fit. I talked about that. does this organization understand that I want to see traction and you've got to get to this product market fit? And is there a sense of urgency around getting that? And then lastly, all things can be great, but if you can't process and scale the business, like WeWork's going through that right now today, while they have a stalled IPO, processes in place, $60 million jet, massively effed up organization that with no process and no scale, right? That's why they're struggling right now. So, that's that on that side. At a video, and I don't know if we have time for the quiz, but we probably don't, but I talked about this entrepreneur life. So if you're an entrepreneur, this is a lifestyle decision for you. And what I've seen in my career is that too much of your soul is sucked dry being an entrepreneur. And I actually think there's a better way, right? So I've got a short video here. I'll set that stage. I don't have time for Q&A. I'll be around. But here we go.
Home. For decades, mankind has achieved wonders on this planet. We've terraformed the land, built cities in the desert, and islands out of sand. Yet at the same time, our forests are burning, glaciers melting, and lakes drying up. Our lives have been threatened by our very own creation. But we are the next generation. We can change our trajectory and course correct what's been done by past generations to create a better future. Entrepreneur Life is a philosophy to spark change. It offers a roadmap to tapping into your infinite creative power through the following 21 principles. Believe in something greater than yourself. Live in gratitude. Strive to make the world a better place. Believe in infinite possibilities. Be transparent. Be kind. Give more. Lead by example. Be bright. Share positivity. Have faith that you will succeed no matter the circumstances. Be present. Continually strive for personal growth. Spend time in nature. Listen. Live in pursuit of perfecting your craft. Have a dedication to defining your own path. Build open networks. Make your own opportunities. Fuel your mind, body, and spirit with healthy nutrients. Know the real prize is the journey. Don't take life too seriously. Laugh, sing, and dance more. Be willing to explore your edges.
We choose to go to the moon. We choose to go to the moon in this decade and do the other thing. Not because they are easy, but because they are hard.
Yesterday, we terraformed the land, built cities in the desert, and islands out of sand. Tomorrow, well, we have a better plan.
Anyway, thank you so much for your time. I have Toby.story@gmail.com, and I actually have a very detailed presentation deck of what, in a lot more detail here, how to think about your business, how to get traction, key questions of investors. If there's anyone that wants to email me, I'm happy to send that deck to you. Thank you so much for your